What is going on, people? Welcome back to another episode of 2 Minute Tuesday, where I explain financial concepts in basic English. Today we are talking about investment banking. What is it? How much can you make from it? And how do you break into it? So let's put 2 minutes on the clock and let's get straight to it. Investment banking, otherwise known as corporate finance, is basically the part of an investment bank that advises companies and governments on how to raise money, how to merge or take over companies, and how to restructure their business in order to be most effective and efficient. There are 5 key areas within the investment banking division. There are mergers and acquisitions, equity capital markets, debt capital markets, restructuring, and leveraged finance. The M&A business is where bankers advise companies on mergers and acquisitions. A merger is when 2 companies come together, and an acquisition is when a bigger company takes over a smaller company. Next, you've got ECM and DCM, equity capital markets and debt capital markets. Whilst M&A focuses on advising businesses on mergers and acquisitions, ECM and DCM focuses on advising companies and businesses and governments on raising capital, so raising money. ECM focuses on raising money through equity, and DCM focuses on raising money through debt. For example, Facebook wanted to raise money through equity, and so an investment bank made it possible for you and I, the public, to buy shares in Facebook. What that means is we get a piece of Facebook, so a piece of equity, in exchange for cash that we give to Facebook. So Facebook gets money, in exchange it gives part of its company away. That's raising money through equity. On the flip side, you've got debt capital markets, so raising money through debt. Think of a mortgage. You're taking a loan and the bank makes money from your interest payments. This is the same in debt capital markets, except the clients aren't humans like me and you. They are massive corporations where the interest payments are in the millions. Then we've got leveraged finance. This is kind of like DCM, debt capital markets, but more riskier. When you think of debt capital markets, you're thinking about safe loans, government bonds. But when you're thinking about leveraged finance, it's basically raising capital with debt, but risky debt. Lastly, we've got restructuring. This is where bankers scrutinize and analyze the structure of a business. So they look at the debt to equity ratio. How much debt does the business have? How much equity does the business have? Is it structured in the most efficient way in order for that business to run in the best interest of shareholders, so on and so forth. So bankers in the restructuring team look at all this and they try and construct the best structure for that company. As a new analyst out of university, you can expect to make between $100,000 and $130,000 in your first year. That will consist of your base salary as well as your bonus payment. Typically, most people that break into the investment banking division or investment banking are those who went to a top tier university, they're really bright, and they've done lots of internships in a similar field or industry. That is this week's 2 Minute Tuesday. I hope you enjoyed it. It probably went over 2 minutes, but I'd rather go over than under. Make sure you tune in next week to learn another financial concept, idea, or term in plain English. Give this video a thumbs up, subscribe to the channel. I'll see you in the next video.